Regulators are getting confident. As they rack up the points against crypto projects, exchanges, and businesses, their confidence increases. This is something that should be alarming many in the crypto space. And no, I'm not only talking about centralized crypto exchanges or projects that ran an ICO. I'm talking about many of those DeFi protocols we know and love. Yes, you may think they are decentralized, but never underestimate the resolve of a determined and well-heeled opponent. My name is Guy, and in this video, I'll be taking an in-depth look at the regulatory risks of DeFi. I will analyze the current laws around securities and break down how they could potentially be used. Finally, I'll give you my view on which protocols and applications are most at risk from these regulatory black swans. You won't want to miss any of it. Speaking of the law, I need to legally cover my behind. Firstly, this is not investment or legal advice. It's merely my own analysis and opinion. You should consult your own financial or legal advisor before swimming in these crypto waters. And then, for anyone new to the channel, a warm Coin Bureau welcome. Over here, I share everything crypto, from the latest news to coin reviews and overviews. Everything that you need to know in order to make the most of your crypto journey. So, if you'd like to join that rocket ship of crypto knowledge, then smash up that subscribe button. Oh, and turn on all those notifications. We all know how damn fast the crypto markets move. And finally, I do encourage you to watch the whole video. It helps to fully elucidate my analysis. But if you're strapped for time, you have these handy timestamps in the timeline right here. So feel free to jump around. Alrighty folks, let's get this show on the road. So, why is regulation all of a sudden such a pressing concern? Well, this is because of some pretty high-profile cases recently. It's important to go through all of these as they help give us an idea of the likelihood of particular laws being applied to DeFi. So firstly, you have that old security chestnut. More specifically, is a token that is sold in an ICO a security? Well, according to the SEC, it is. This is all based on that famous, or infamous, Howey test. For those of you who don't know what this is, it's a set of questions that one has to ask to determine whether an asset is classed as a security. I've linked to our piece on it below should you want a further read. Now, the SEC has used this a number of times in the past to bring down projects that raised ICO funds from US investors. Two of the most high-profile of these have to be Telegram's Grams and Kik's Kin. So let's start with the former, shall we? For those of you who have never heard of the Telegram token raise, this was one of the largest ever, just behind Block 1's raise for EOS. They sold SAFT token agreements to a large range of accredited investors, and they were able to raise a total of almost $1.7 billion. This was to be used in order to develop their TON blockchain, which is when the tokens would be issued for those that bought in. However, here's the catch. The SEC alleged that the TON SAFT sale was an unregistered security offering. So in October of last year, they issued a restraining order against any more sales of the TON tokens. This clearly threw a spanner in the blockchain and meant that Telegram could not continue the rollout. Eventually, in May of this year, they announced that TON was officially dead. No doubt a gut punch to those investors who were hyped about the launch of this project. Not only did Telegram have to return all of the money that was sent to them by the investors, but they also had to settle with the SEC in a civil case for almost $19 million, a nice chunk of change for the SEC. What's important to note here, though, is that there was no admission of any wrongdoing by Telegram, and it did not go to court. This is quite different from the Kik ICO case. So let's touch on that, shall we? Kik was a pretty dated messaging app that was mostly used by teenagers a few years ago. However, in 2017, and for reasons still disputed, they thought it would be a good idea to do a token raise. They were able to take in almost $100 million in exchange for their Kin tokens. The problem with this was that they issued many of these to US investors, and they did not register the token as a security. Now, while there were many other projects that did this, Kik was one of the most high profile. There were also questions as to the motivations behind this. The SEC asserts that the token itself was merely a Hail Mary pass by a company with a dying app. Now, those technicalities aside, it clearly breached security laws. The SEC sued Kik for $100 million for the token raise, a massive sum which the company clearly did not have. Kik decided that they were going to fight the charges with what funds they had left. It couldn't have been that much though, as they tried to set up a legal defense fund in order to help fund the lawsuit. Well, fast forward to the 30th of September this year, and the lawsuit ended in Kik losing to the SEC. Some say that this was inevitable, but it's important for a number of reasons, not least of which is that it has established legal precedent. This is because it was the first time that a judge has actually answered the very specific question of whether a digital token is a security. This judgment means that it can be referred to in any future cases that are brought before the US courts. The judge also used that infamous Howey test in order to come to that conclusion. Now, these were both actions that were brought against initial issuers of tokens. However, we have also had two high-profile actions taken against exchanges and trading apps. So let's dive into those now, shall we? The first one I want to touch on is an app called Abra. This was a fairly popular trading app that allowed users to enter into contracts that provide synthetic exposure to the price movements of stocks and exchange-traded funds, ETFs. You could think of these as security swaps that the users would enter into in order to gain exposure to US markets. The only problem with this is that it falls squarely into the realm of the SEC. The SEC alleges that Abra was, quote, offering and selling security-based swaps to retail investors without registration. They also did not hedge these swaps on a nationally registered exchange. It wasn't only the SEC that took issue with Abra. The CFTC also wanted their pound of flesh. They alleged that Abra was allowing its users to enter off-exchange swaps in digital assets and foreign currencies without being a registered swap dealer. This is in contravention of the Commodity Exchange Act. Thankfully for Abra in this case, they did not have to admit any wrongdoing. They could just pay a fine of $150,000 to each agency and stop their non-compliance. So, a slap on the wrist, basically. However, a company that was not given similarly light treatment was BitMEX. In fact, the BitMEX charges could be some of the most aggressive that we've seen in the crypto space, and to one of the biggest targets. It shook the crypto community. So much so that the price of Bitcoin took a bit of a dump when it was announced. The US Department of Justice brought a slew of charges. This was in conjunction with the CFTC that had been investigating BitMEX for over a year. Not only did they take issue with the fact that BitMEX was operating as a swap dealer without a license, but they also accused them of violating the Bank Secrecy Act, a criminal offense. They claimed that the exchange was allowing users in the US to trade there without conducting any sort of KYC to make sure that US traders could not trade on the platform. There were also some pretty serious allegations around the exchange being used by Iranian traders. As we know, Iran is officially sanctioned by the US, and breaching those sanctions is viewed pretty damn seriously by US authorities. Of course, it also did not help that Arthur Hayes, the BitMEX CEO, bragged about bribing Seychelles regulators with a coconut. Not something I would have done if I knew I was being investigated, but hey, each to their own. The US authorities charged the 3 co-founders and 1 employee. They managed to arrest one of the founders in the US, while the other 3 remain at large. Of course, they have a right to innocence before being proven guilty, so we will have to see how this plays out. So what does all this show? Well, it shows that the US regulators are getting much more active when it comes to enforcement. In the case of those companies and businesses that continue to flout the regulations, they are taking a much more hardline approach. It also raises stakes for individuals involved in the crypto space. Paying a fine is one thing, but facing prison time is something totally different. Coconuts won't get you too far in a federal penitentiary. Now, these examples that I've talked about are just a few select cases. There are no doubt a lot of other cases related to the cryptocurrency space. However, one of the most important questions is how this all relates to DeFi. So, let's take a look. DeFi, or decentralized finance, is, well, decentralized. This is one of the main reasons that proponents think it cannot be targeted in the same fashion that CeFi services can in the crypto space. They point to the fact that all of these services exist on a distributed, immutable, and censorship-resistant blockchain. They claim that all of these properties mean that a regulator cannot bring it down. Well, I would challenge that assertion. This is because, although you may think that it is decentralized, very few of these protocols and dApps are fully 100% decentralized. This basically means that there are centralized areas of control that the authorities could target should they want to bring a project down. For example, let's consider your average decentralized exchange. As we all know, these are anonymous and anyone can use them. There are many issues that a regulator could take with them, but perhaps one of the most pressing is the fact that they can be used by criminals to launder crypto. What you should know about many decentralized exchanges, and DeFi protocols more broadly, is that the developers themselves control God keys. These are basically the keys to the main smart contracts underpinning the entire protocol. If the authorities knew who the developers were, they could easily seize these God keys and take over or shut down the protocol. Yes, many of these protocols have multi-sig setups with numerous key signers. However, all they need to do is convince a minimum number of devs to hand over the keys. Something that could be pretty easily achieved through the threat of a lawsuit or worse. Okay, let's assume that the developers are completely anonymous and cannot be located. Or even better, there are no God keys and all protocol changes are completely controlled by a DAO, a decentralized autonomous organization. In this case, they may not be able to shut the protocol down, but they can definitely take aim at any centralized component of it. For example, let's assume that it's a decentralized exchange with the front end hosted on a centralized server. Most servers these days are within the reach of law enforcement. Unless you choose some bulletproof hosting providers in a country with no cooperation agreement with the US, the front end is within reach of the feds. Okay, let's assume that it is hosted in a location that's beyond the reach of the regulators. Or better yet, let's assume that the front end is hosted on IPFS. This could be an ideal solution, as IPFS is a decentralized technology. Oh, and for those of you who don't know what IPFS is, it stands for Interplanetary File System and is a peer-to-peer protocol for distributed data and file storage. It allows people to host censorship-resistant websites. Interestingly enough, it's also being used by the likes of Filecoin, a project with a hotly anticipated mainnet launch, one you definitely want to keep your eye on. But I digress. Where was I? Yes, our hypothetical DEX. So yes, they can host it in a bulletproof location, or they could use IPFS, but they will still have to route users to the site. As most know, DEXs still use centralized domain names. Uniswap.exchange, synthetics.exchange, dydx.exchange. All of these generic TLDs are technically seizable. All the authorities need to do is get a warrant from the registry and they can take down the front end of the site. The same can, of course, be said about .coms, .nets, etc., etc. Of course, the DEX can always pop up on another domain that was mirroring the main one, so it becomes a whack-a-mole exercise. They could also get themselves some obscure TLD from the likes of Somalia or Gabon, very hard to seize. Of course, this makes it quite a laborious exercise where it's a game of cat and mouse with the man. One of the best solutions that I can think of is if the DEX front end were to use a blockchain domain like .eth. These are decentralized and cannot easily be seized. The only problem with this is that .eth domains are not DNS registered. This means it's not easily accessible through your normal web browser, although there are workarounds. Anyways, let's just assume for the sake of argument that we have an ideal solution. One where there is a DAO-run protocol with no God keys that's hosted on IPFS and uses a decentralized domain service. This would be very hard for the authorities to restrict. But they could make it damn hard for anyone to use it. Allow me to explain. Most of us crypto users use a centralized fiat gateway at some stage, either to convert our cash into crypto or realize our crypto gains. Most Lambo dealers deal in dollars after all. This all means that we are, for better or worse, quite reliant on these services. We need our accounts there, and if we do anything that they don't like, they can easily close them. This has actually happened quite a bit in the past. For example, I know a mate who had his Coinbase account shut down because he was sending funds to an online casino. These exchanges are also likely to quickly shut down any accounts that receive funds that are associated with any crypto mixing services. These exchanges are able to do this, of course, because they have become pretty damn effective at tracking the blockchain. Blockchain auditing tools are usually able to pick up any addresses with questionable activity attached to them and shut them down. So, why am I telling you this? Well, I'm trying to illustrate how easy it could be for these centralized fiat gateways to track incoming transactions. So, let's just assume that the authorities implemented new directives that exchanges could not operate accounts for those people who have interacted with a decentralized exchange. Given that blockchains are easy to track, this means that they can easily identify those accounts and shut them down. So, if you're someone who likes to use your DEXs for all your ERC20 transactions, the moment that you take any of these tokens over to an exchange, they could send you a nasty message. And in this case, the message is worse than the text my ex sent me when she broke up with me. It's a message that my account has been closed. All this means that using a DEX could be a risky endeavor, assuming that you want to keep your fiat gateway accounts open. Okay, so I've painted a pretty bleak picture for you there, but I think it is important to at least have an idea of potential regulatory black swan events. If there's one thing that 2020 has taught us, it's that black swans do happen. So, let's assume this regulatory tail risk were to happen. Which protocols and platforms would be most at risk? Well, it's pretty obvious that they're likely to want to target some of the biggest players in the space. Yep, those regulators like to go unicorn hunting. And speaking of unicorns, Uniswap could be a potential target. This is for a number of reasons. Firstly, they are the largest DEX on the market with the most trading volume. This means that Uniswap can, and in fact has been used by some people to launder crypto funds. For example, more recently it was discovered that Uniswap was being used by the KuCoin hacker to convert some of his funds. Of course, there are no KYC records to keep, and hence it means that the hacker was able to use it to his heart's content. Not something regulators would be too happy with. Then, of course, there's another aspect to Uniswap that could raise the ire of the SEC. That is, of course, that Uni token airdrop. There are many that were musing that this could fall foul of the rules around regulated security issuance. If the Uni token meets the definition of a security, and it seems like it does, this means that it was an illegal issue. Oh, and while we're on the issue of this Uni airdrop, you may want to watch my video on the topic. I go into it in depth. Anyways, Uniswap could be a target. They are definitely not the only one, however. Another DEX protocol that could be a target is Synthetics. For those that don't know what it is, it's a DeFi protocol that allows users to trade tokenized synthetic representations of other assets, crypto, fiat, commodities, and stocks. I've covered it before in a separate video, which you can watch right here if you're interested. Anyways, given that Synthetics used to have derivative instruments on real-world assets like stock market indexes, it made them a prime target for SEC action. It looked a hell of a lot like the Abra app that got that SEC beatdown. This is perhaps one of the reasons they removed equity index synths. Indeed, the SEC question was no doubt a major concern for the developers themselves, and was one of the main reasons that they moved to dissolve their foundation last year. They began their steps to a full decentralization operating on a DAO model. Of course, as is the case with Uniswap, even with the DAO, it will not be fully decentralized. Control of the admin keys will be in the hands of the protocol DAO. Here, there will be 8 individuals who control it, and the contracts will be secured with a 4 of 8 multi-sig wallet. So, all that the regulators will need is to grab control of 4 of those keys, and they can easily shut the protocol down. And, as is the case with Uniswap, it's hosted on centralized domains and the front end is still on a centralized server, easy to grab a hold of if they wanted to. And I should, of course, point out that back when Synthetix launched an ICO, previously called Haven, they sold their own SNX token. Could this also have fallen foul of SEC rules around securities? I leave you to be the judge of that. Time to wrap this video up, ladies and gents. I want to state categorically that I'm not picking on these two projects. I'm just using them as examples of two well-known dexes where regulators could theoretically make a case. There are a plethora of other projects which could also cross some legal lines. But then again, crossing certain legal lines does not automatically mean that a project or protocol will face regulatory action. Let's not forget, Ethereum could technically have accused of being a security sale, but once the genie was out of the bottle, the SEC perhaps realized it was pointless to pursue. The same could be said about Uniswap or Synthetix. May I also remind you that there are numerous US-based investors that are backing Uniswap. I think it's highly unlikely that this lot would have been okay receiving Uni tokens if they thought large regulatory action was a possibility. So yes, I personally don't think it's likely. This is the reason why I don't mind holding my Uni for the long term. To join it on the journey to a fully decentralized community-governed AMM. However, I do think it's important to at least be aware of potential regulatory risks. It is a black swan that cannot immediately be discarded as impossible. As I've shown, a determined regulator could shut down or severely hamper a protocol. I bet the guys at BitMEX never thought that US regulators would be arresting them for severe crimes. But here we are, and that is exactly what happened. All I'm saying is, know the risks and weight them by the probability of it happening. This could adjust return expectations. And that's it, folks, my take on the regulatory risk of DeFi. Of course, this is just one crypto guy's view, so I need to hear from you. Do you think it's a fair analysis? And are there any other DeFi projects which you think could be at risk? Fire your comments below. Also, while you folks are down there, you may want to check out my personal deals page. It's basically a collection of some of the best promos and deals that I could put together exclusively for the viewers of this channel. So, do check it out. And finally, folks, thanks so much for watching. You guys rock. If you got value from this video, then smash up that like button. And be sure to subscribe, as you won't want to miss what I've got coming. I'm so glad you made it to the end of that video. Now that you're here, I have something interesting to share. Have you heard of my weekly email? Basically, it's my personal take on the crypto markets. Everything from hot projects to hot coins. Unique insights on market movements, as well as some news that may have dropped off your radar. That sound appealing? Well then, I'm inviting you to sign up. Head on over to the description right now. There is a link to my sign-up form. Then you pop in your email and hit submit. Then you'll just have to confirm your email, and that's it. You are locked, loaded, and ready to go. You may just catch my next newsletter, which you definitely won't want to miss.